Hi friends, welcome back to the channel. My name is Bunty. Today, let's talk about Intel. First, let's take a look at the price chart. Intel share price is essentially flat year to date, while the broad market went up by 23%. I have to say that I was very bearish on Intel when it was led by the previous CEO Bob Swan. I think Bob Swan has failed to spend the required capex to keep up with the competition and only know how to use share buyback to optimize for earning per share. However, early this year, Gelsinger took over as the CEO and he has made a couple of important changes to the company. We will talk about it in details later. In this video, I'll be covering the following: third quarter earnings result, why the share price plunged after the earnings result, and Intel's IDM 2.0 strategy. Let's get into the quarterly earnings. The earnings per share was at $1.71. This was higher than the expected earnings per share at $1.11. The numbers was largely boosted by a large gain on equity investment. If we take out the equity investment gains, the quarterly earnings per share was mostly in line with estimates and possibly below the $1.11 per share target. The revenue of the quarter was at $18.1 billion, which falls short of the expectations of $18.24 billion. Intel reported revenues grew nearly 5% year over year, but revenues missed analyst estimates by $170 billion. Intel's largest business, its client computing group, was down 2% year over year to $9.7 billion. That includes PC chip revenue. Intel said that the PC sales were down primarily due to lower laptops volumes because of the chip shortage. Gelsinger said that PC demand was still strong and he didn't expect the semiconductor shortage to end until 2023. Intel's data center group, which sells processors and other silicon for data centers, produced $6.5 billion in sales, up 10% year over year, but fell short of analyst estimate of $6.66 billion. Okay, if we look at the quarterly financial result, yes, it is slightly below the expectation, but not so serious to the extent that the share price deserved a drop of 11% after the earnings release. So, it has to be something else. After some research, I noted that the share price drop was because Intel just communicated that there will be massive capex in the coming years. Intel spends $20 billion this year, including on a new semiconductor factory in Arizona. Investors are closely watching Intel's gross margins as the company spends on ramping up new production lines to keep up with the competitors in performance. Intel said its gross margin, the revenues left after accounting for the cost of goods sold, will decline, though it won't drop below 50%, and after that, it will recover. For the third quarter, Intel reported a gross margin of 56%. This expected drop in gross margins from 56% to 50% may seem small, but actually it is quite significant. Let's take a look at this illustration. Gross margin is after deducting the cost of goods sales. After that, you still need to deduct the expenses to arrive at the net margin. Intel net margin is around 24% now. If you take a 6% cut in the margin, that means the net income amount will drop by a quarter. So it really depends on whether the shareholders are patient enough to wait and how much confidence they have on Intel's future revenue. Imagine that if the revenue slows down, AMD grabbing more market shares, then the impact to net margin would even be larger than a quarter. IDM 2.0. This increased capex that was just mentioned is necessary given that Intel plans to shift its business model to become a manufacturer not only for their own product but also for other chip designers. Intel called this new model Integrated Device Manufacturer or IDM 2.0. This new model includes significant manufacturing expansions, plans for Intel to become a major provider of foundry capacity in the US and Europe to serve customers globally. Let's take 1 minute to understand what is this all about. If you want to skip this part, feel free to skip forward using the timestamps.
Since our founding, Intel has been an integrated device manufacturer, or IDM, a semiconductor company that both designs and builds computer chips. IDM 2.0 is our evolution. Here are 3 things to know about Intel's IDM 2.0 strategy. First, we will continue to build most of our products in Intel factories, remaining a global leader in chip making and process technology. Second, we will expand our use of external foundries to make some of our products. Foundries already manufacture a range of Intel products, from communications and connectivity to graphics and chipsets. Third, Intel Foundry services will serve the exploding global demand for chips. We will make them for fabless companies offering our world-class process technologies, advanced packaging, and a broad IP portfolio. CEO Pat Gelsinger says that IDM 2.0 is a powerful and winning strategy that will change the course of our business for the future.
So Intel is going to set up a foundry business, one that will contract manufacture chips with 2 new fabs in Arizona. They will be run as a separate business units with its own committed capacity. This is an important signal because a foundry has to be dedicated to serving its customer and can't prioritize Intel's own internal needs. What do I think of the IDM 2.0 strategy? I actually think that Intel has made the right decisions with regards to the IDM 2.0. Imagine what would happen if Intel does not invest enough to upgrade their manufacturing capacity. Both TSMC and Samsung are not slowing down in their capex because they are still trying to grab more market share. Intel can't survive long if they just sit there and using their free cash flow to buy back their own shares. So now they have decided to spend the money. Then you will likely to see the hit to the income statement in coming few years. Expenses goes up, revenue will goes up but not immediately. Earnings will likely drop and the PE may look worse. The way I see it is that value investors that only invest based on earnings may start to give up on the company once they see the earnings keep dropping in the near future. If you are a long-term investor and you understand this dynamic, you might say, okay, I'm just going to hold this for 5 years and see if Intel is able to execute well. After they ramp up their capacity and they are able to secure new contracts, then they will be able to attract new investors that are more growth-oriented. Next few years will be crucial for Intel because the execution risk will be quite high. Developing advanced process nodes in semiconductor manufacturing is not easy. To get a decent yield is not an easy job. It is not like you get a couple of EUV machines from ASML, then you can have the same result as TSMC. There are many details that only experienced engineers know how to tackle to have a good yield. At the same time, I also cannot say that Intel doesn't have a future. At least the strategy is the right one, they just need to execute the strategy that has already been laid out. Besides that, Intel is also getting some help from the US government via the CHIPS Act. The full name is Creating Helpful Incentives to Produce Semiconductors for America Act, a funny name in my opinion. This act will 1. Fund research into semiconductor design and production. 2. Create a pool of federal money to give manufacturers incentives to build semiconductor manufacturing facilities in the US. And 3. Provide a tax credit to those who do so. The act will provide $52 billion to start funding such initiatives. So this is definitely something that could help Intel. Alright, that's all I have for this video. If you find my video helpful, please like and subscribe and share it with the people that you think may be interested. I also invite you to join my Telegram group, link is in the description. Also, in the description, I have included a Bloomberg interview with Gelsinger. You can listen to him and get a feel on whether you want to join Intel in this recovery journey. As a disclosure, I currently do not own any Intel shares, but I still wish Intel to be successful. Let's make America great again. As always, please remember to do your own due diligence. See you in the next one. Cheers. Bye bye.